The boroughs are New York City. The burbs are everywhere else. Real estate is the ultimate game of risk and reward. It's the biggest investment most people ever make. Fortunes are made over a lifetime and lost in a day. And we're not playing with monopoly money. How do you stay ahead? Who's buying? Who's selling? And why? What do they know? We want the truth. You need an edge. Boroughs and Burbs is your secret weapon, giving you the insider knowledge and strategies you need to succeed in the high-stakes world of real estate. From Palm Beach to Palm Springs, Manhattan to Malibu, we press the experts to expose the pain, find the deals, and occasionally predict the future. That's Boroughs and Burbs, Thursdays, 3 o'clock Eastern, noon Pacific. Because everyone can make money in real estate.
Welcome, everybody. Boroughs and Burbs 222. We're doing cost segregation today. I know Roberto gave me a little bit of the eye roll. I could tell, and it was like, there's going to be math. This is not something that, is part of my life. This is something somebody else might think about. No, Roberto, this is something you and I need to know about, and we can take advantage of it. So we've got two experts on the show today. Jason Melillo, Sumit Sharma of KBKG, and they're going to walk us through cost segregation and why it's relevant to regular guys like us. How are you doing, Roberto?
I'm good, but I can tell you one thing, just the definition, cost segregation, I'm like, what does that mean? So let's bring our audience in and let's learn.
Okay, so why don't we begin at the top and ask our two guests to introduce themselves and how they got in the business and how long you've been doing this.
Sure. Well, I'll introduce myself first. I'm Jason Melillo. I'm the CEO of KBKG, co-founder. I'm a CPA and started in cost segregation about 26 years ago when we learned about how the big firms, the big four firms, were utilizing it to help their clients. And we realized that there was an opportunity to make it accessible to the middle market and on down. And we thought, well, there's no reason that only the Fortune 100, Fortune 500 companies should get to benefit from this strategy. So we learned how to bring it to the middle market, and back then it was something that very few people have heard of, and now it's pretty much prolific. So we'll kind of talk about the definition in a minute, but we'll let Sumit introduce himself.
Hi, John. Hi, Roberto. My name is Sumit Sharma. So I'm a principal here in the Northeast. I lead the practice. My office is in Midtown Manhattan. So a little bit about my background. I'm an engineer by education. Found my way into this tax world. I've spent probably the better of the last 20 years focused on tax credits, tax incentives like cost segregation. Started out early doing valuation, appraisal type work. Spent some time in public accounting as well, doing these types of services. And then, a little bit over the last decade here with KBKG on the operational side, but I do spend quite a bit of my time also business development, practice development.
All right. And Roberto, where are you? I forgot to ask.
Ask me every time. I'm on the Upper West Side of Manhattan, my dear friend.
And where are you, Sumit?
So I'm sitting in the office right now in Midtown. But I live in North Jersey. I commute into New York.
And how about you, Jason?
I'm in Los Angeles.
Yeah, I can see trees. I can see trees.
So both coasts represented. All right, so let's start with, I'm going to pull up your homepage while you talk, but why don't you introduce us to what is cost sharing?
Sure. So
cost segregation. Sorry, cost segregation.
That's all right. Cost segregation is a method of accelerating depreciation on rental real estate. So anyone that's invested in real estate knows that the investor gets to deduct something called depreciation, which is just a non-cash charge or expense to their tax return to allow them to recover some of their upfront costs that they've invested in that real estate. So it's a non-cash tax deduction. And under the statutory rules for rental real estate, it's generally depreciated over either 27 and a half years or 39 years, unless you do a cost segregation study. Just the building portion itself is 27 and a half for a residential rental property and 39 years for commercial property. A cost segregation study allows us to carve up that purchase price of that building. And instead of depreciating it over the 27 and a half or 39 years, we actually get to break it into different pieces. And some of those pieces get depreciated over shorter lives, 5 years, 7 years, and 15 years. And so because of being able to depreciate it in those shorter lives, we get more tax deductions early on in the ownership of that property. And more tax deductions means that I'm sheltering more income and I'm keeping more of that cash for myself to either reinvest in real estate, or maybe I use it to pay down the outstanding debt on the property, or maybe if I'm John's wife, I use it to go sit on the beach somewhere. So I think that's the idea, is it allows you to do different things. And then we can talk a little bit later about bonus depreciation and how that supercharges cost segregation and really allows you to maximize the benefits. Um, I don't know, Sumit, if you want to chat a little bit about the
What
different.
what I think I hear you saying is
Yeah,
this is for investment properties, not my primary dwelling. Is that true?
that is exactly the case. It's
But it
not.
can be an office or a residential
It
investment
can
property.
be any investment property. So it could be an office, multifamily rental property. It could be a stadium, an office tower. I mean, you name it. It could golf course. It applies to any investment property.
And fundamentally, that two-family house that I purchase, what you're saying is that I can break the two-family house uh, into component parts that have different depreciation schedules. Is that essentially it?
That's correct, John.
Can,
Yeah, I mean, to
can I
really
ask a
boil it
question
down,
though? Can I ask a question, Sumit,
yeah,
before you start? Just say, who came up with that? And who said that all of a sudden you can do that? Because it's complicated enough as it is. So who is the person who's writing the tax code? Say, well, why don't we allow people to break this up? Or who's doing that? Or is it proposed? How does that happen?
Sumit, I'm going to let you go ahead and take that. You're going to go back to the 1960s?
I mean, is that how far
I'll
back
go
it
back to
goes?
I'll go back as 1987. It predates my time in the industry. Sorry if I'm dating you, Jason. But no, the tax law was written. There are certain sections of the tax code that allow. It really goes back to the investment tax credit and allowing real estate investors to recover the cost of their investment through depreciation deductions. That's when these codes were written. There were specific classifications for specific asset types, components, as you were talking about, John. And this law has been litigated. The IRS has challenged certain taxpayers on some of their cost segregations, and it is those court cases and some of those litigated courses that have allowed us to identify what we can and cannot segregate. So we have it's a tax strategy, tax tool that's been around for many years, Roberto. There's even published guidance by the IRS as to how these studies should be prepared, what things should be considered. Call it a rule book, a playbook that guides practitioners like ourselves, so that we're not out of step with Treasury and tax law.
I found this picture, which might actually help to talk about what are the components. So without a cost segregation study, it's just a building and land. But with the cost segregation study, I can pull out personal property and improvements. And I believe probably if I'm a developer, I can even take my developer costs, right? My salary developing the project. Is that true?
That's correct. There's a lot of ancillary development related costs, John, architect, engineering fees, development fees, that can be lumped into the total cost of developing a property, building something.
And this just got more powerful in the last couple of years, not just since the 60s, but in the last couple of years. Hasn't the IRS started to allow even more accelerated depreciation in some categories?
Certainly. So when Jason was kind of introducing cost segregation, some of those categories that he was mentioning, he used the term short life recovery. Typically that was a very good image. I think the layman's, a real estate investor, even many tax professionals see a building as a single asset, a single thing. It's a building, and they depreciate that over a long period of either 39 years, 27 years, very slow and steady depreciation. As Jason mentioned, it's a building, at least the way we see it, is more than just one thing. It's made up of many, many components that can not only be depreciated faster or accelerated, but there is this concept called bonus depreciation. Bonus depreciation has been around for many years, since 2001 in various forms. It's, at various rates, but the recent One Big Beautiful Bill increased the bonus depreciation rate to 100%. That was what you're referring to. So allowing many of those components that we're describing to not only accelerate, but to be 100% written off in the first year.
So that's why this is particularly interesting in 2026. Are you seeing
Absolutely.
people? The phone is ringing off the hook now that we have the big, beautiful bill and people have heard about this the bonus depreciation?
Yes. Yes. Times are busy.
So tell me why. Give me a case study, and Roberto, on somebody who's been able to make use of bonus depreciation and cost segregation study to score a big win.
Sure. Let's give a simple example. You have somebody that owns two properties. They've owned them for a while, and they're generating some taxable income, and they are they've used up a lot of their depreciation, and they're looking for a way to shelter additional income, and they want to continue to invest in real estate. If they have, let's say they're producing $250,000 a year of rental income that's taxable. If they were to go out and buy a property, let's say they spend $1 million on another, you know, 3-4 unit apartment building, and they are able to do a cost segregation, they could generate about $250,000 of depreciation deductions using the bonus depreciation in year one. So they take their tax bill from taxable income on 250,000 down to zero in that example.
This
And
must be a lot of work for you
I'm trying to
guys.
keep the numbers nice and round for you, Roberto, because I know John was teasing you
I don't know
about
where he's getting
not being a
offended. I don't know how
numbers
to do
guy.
math. But this must be a tremendous amount of work for you guys because of it's additional accounting on every single silo of that project, say, right?
Yeah, I mean, Sumit, you can kind of talk about the how it works.
It's actually quite simple, Roberto. I mean, the premise of the work is doing cost estimation, building a model. Hence why a lot of the folks on our team have either a construction or engineering background. It's not actually quite a lot of work on the tax preparation or the CPA tax preparer side. The law allows you to break your building, your real estate, into various components, and we're talking about only a handful of categories. And so it's, from a mechanical standpoint, from an actual tax preparation standpoint, not a lot of work, but from a practitioner standpoint, there's kind of two ways to look at this, and it runs the gamut back to the math. Again, not to make it too complicated, Roberto. The larger the basis values, the greater the benefits. It's math at the end of the day. $1 million home, $1 million piece of real estate versus a $10 million piece of real estate. $10 million is going to lead to a greater depreciation, greater benefits. But it doesn't really necessarily change the way the modeling or the componentization works.
So it seems like an obvious slam dunk thing to do. What are the drawbacks? What is the, if you do this, then you can't do this, or if you're going to have the property for 20 years, you've used it all up, or whatever, talk to me about that.
Sure. Yeah, let's talk about that, because there are instances where a cost segregation study isn't appropriate or isn't necessary. Let's say the example I just gave, you've got somebody that has two properties and they don't have any taxable income because they have sufficient depreciation from those two existing properties that covers that income. So they don't have passive income. If they're not a real estate professional, they don't meet any of these other opportunities that exist, and they buy another property, creating more of a tax loss doesn't help them. Passive income and passive losses, if you're a passive taxpayer, so I'm not a real estate professional, so I can't use my losses from my real estate activity from a standard rental property against my W-2 income. That doesn't work. Okay. There are instances where it can work, and I can talk about that example, but I want to just talk about this example for the moment. So if I generate more losses from this property, it doesn't help me. So I wouldn't spend the money to do a cost segregation study today to get those additional losses because there's no value in it. Now, let's say we fast forward 10 years and I went ahead and bought that property anyway, and now I own 3 properties, and 2 of them are providing a nice tax deduction for me, or taxable income for me. I can go and I can do a cost seg study on the property that I bought more recently and do the catch-up depreciation from the cost segregation study to offset the income from those other 2 properties. So what the tax law allows us to do is to pick and choose when we do these studies on properties. We can go back in time, and we don't have to amend tax returns. We can do a catch-up. It's called a change of accounting method. We can do that catch-up on a current tax return and take all the missed depreciation that we could have had by doing a cost segregation study and take it in the current year against our other income.
In a one-time catch-up?
Yep.
I can do that with property I already own. Same thing with Roberto.
Yes, exactly. Now, Roberto, I want to give you another example of what the impact could be. If you were going to buy a property, hold it for 2 or 3 years, and then sell it, just outright sell it, not exchange it, sell it. If you did a cost segregation study, it could create something called recapture. So when you get deductions from depreciation, and that's against ordinary income, then when you sell and you have to recapture those deductions, that's also at ordinary income instead of capital gains. So if you were going to just buy, hold for a few years, and then sell, again, cost segregation study might not be appropriate for you, depending on how long you held it. If you were going to hold it for a longer period of time and you had the taxable income to offset, then there's probably a benefit for you because you're, again, kicking the tax can down the road and you're paying those taxes later.
Why do you have to recapture it?
Well, because that's what the law says. So, but like most people in real estate, we don't like to pay taxes. So a lot of people in real estate are familiar with 1031 exchange.
Yep.
And the idea of, I'm not going to sell that property, I'm going to trade it. And so when I trade it, I don't have to recapture if I trade for something of equal or greater value. Then I can continue to defer the taxes down the road, and there's no downside. If I'm going to trade for something less, then I'll have a certain amount of recapture, but I'll have less than I would have had if I sold it outright.
I'll add this also too, Roberto, and not to kind of scare folks about recapture and this issue at the time of sale. Jason was kind of talking about timing. Not only can we look backwards, we use this word and we use this concept of timing because it matters. There's as most of your audience understands the time value of money. That is at the heart of cost segregation. We are front-loading deductions in order to reduce tax liability now, take advantage of increased cash flow now, because dollars that we are saving, dollars that are benefiting us now are worth more to us than dollars over time. And so back to that recapture concept, the more time, the more you've owned the property and extracted the value of doing cost segregation, the less recapture is a negative factor. And so that kind of matters too. If Jason's right. If the intention is maybe to sell within a near future, maybe 1, 2, 3 years, I think the recapture hit would preclude someone from pursuing cost seg. But if you're holding generally, this is generally speaking, for longer than 4 or 5 years, recapture shouldn't be too much of a concern because of the value extracted from doing the cost.
But the recap. So let me just understand. So let's just say you've owned it for 5 years and you've captured 10 to 15 years worth. You only have to recapture that extra amount that you would have not been able to experience of that you've pulled forward.
Yes.
Just the excess, not what would have been natural.
Right, because we're talking about the shorter life property.
Yeah, that's all.
Yeah.
The one thing that I will say is, even if you were going to hold the property for a shorter period of time, it can still make sense. And here's an example. You've got a bunch of income in a current year, and you're going to be able to offset that income at a higher tax rate. You're in the maximum rate. You're at 37% federal, and you know that a year or two down the road, you're actually going to be in a lower rate. You could end up still way better off by doing the cost seg on the property and taking that deduction in the current year, because you're getting a 37% deduction versus maybe later on you're in a lower tax bracket, and so you're getting that, again, that time value, but also a rate arbitrage.
Yeah.
And so that's where talking to your CPA and having that conversation with your tax preparer, your tax advisor about, okay, hey, here's all the different pieces we have to work with. We can provide the value of what the deductions will look like, and then the investor works with their CPA to say, okay, do we want it this year? Do we want it next year? When's going to be the optimal time for us to take those deductions?
Smart.
I'm going to pull up an example so we can start to see this in real terms. This is their website, costsegregation.com. Those were 3 of the case studies and that may answer the question, is there a minimum size deal? Well, this is a $370,000 purchase price, less the land, $1.2 million and $830,000. But there is a calculator on their homepage, and I just put in a made-up address, 100 Main Street, purchase price $1.4 million, single-family home, date of purchase today. I estimate the savings, and it came out as $230,000 to $434,000 of deductions, offset taxable income, and reduced tax liability. Can you talk to me a little bit about the assumptions going into this calculator?
Yeah.
Sure.
So
Yeah.
Go ahead, Sumit. You're in the weeds here, so let's let you do it.
Yeah, no, generally speaking, what are those things that we were talking about that can be accelerated into the shorter recovery periods? Residential properties are pretty homogeneous, right? They have kitchens, they have living rooms, bedrooms, family rooms, and so there's removable flooring, there's certain cabinetry, millwork that in the kitchen areas. There's a lot of electrical and plumbing connections associated with the appliances. These are all items that can qualify for accelerated depreciation. And so on average, I would say, and this is sort of just back of the envelope, anywhere from 20 to 25%, sometimes even greater, depending on how large the site infrastructure is, meaning the outside pool, landscaping, driveways, things like that. Anywhere from maybe 20 to maybe even 30% of the basis, that 1.4 million that you put in, John, can be reclassified. And so that's how it's kind of, coming up with an estimate. And that's deductions. What you can assume, maybe we're dealing with an individual. They're at the highest tax bracket of 37%. Maybe they're in a certain tax state. So 40% of those deductions, that would result in maybe $50,000 to $80,000 in cash tax savings against their tax bill. So pretty significant, savings and benefit on that example property there, John.
I mean, it's very relevant right here out in Connecticut right now, Roberto, as everybody talks about affordable housing, and they're like, how do we make affordable housing affordable? And, how does a developer afford to come into a community and build things for below market rents? And I want to say that it's on the front page of the New Canaan paper this week that a developer came in and bought for $1.4 million a small piece of property and intends to build 14 units of affordable housing. And he says, when I'm done, I'll build it and then I will sell it to an operator below my cost and I'll move on to the next project. So I've been scratching my head, Roberto, thinking, how can he, and a lot of people in town, how can a developer build and afford to sell below cost? And cost segregation is part of the answer. I'm going to pull up I'm going to pull up my analysis.
Is that why you used 1.4 million?
I did. It's exactly why. So he paid 1.4 million for the property. He says 14 units. It's an 18,000 foot building. Cost per unit, that's in line with expectations. Total development cost in this scenario, $7 million. By the way, I had another investor come ask me about this case study this morning. So a lot of people are thinking about this kind of a deal. So if they put $7 million into a project and you have this math here, equity raised 4.8 million from investors. You take on the debt, affordable rents don't support big loans. Gap funding, very common in Connecticut, state and local support. Soft 500,000 to $1 million in soft funding. Your total source is 7 million. Here's the key. The construction 5.5, but his soft costs, I believe, are going to be part of that cost segregation study, and the developer fee part of the cost segregation study. So where does this developer make his money? Developer fee, 700 grand. That's paid up front, part during construction, and then construction management adds another 100 to 300. His tax credit economics structure the partnership, earn a back end interest. So that's one way the developer can sell it below cost. But the key is the loss on sale. 7 million he's got into it. Sale price to operator 6 million. He's calling this a $1 million loss and offsetting that against his income on other projects. This is after he's already earned a $700,000 developer fee in the project and the potential tax benefits he's getting and the additional fees. The cost segregation layer is he accelerates the write-offs on that project before he sells it, and he creates those paper losses early. That's the key I wanted to get to today.
But does that exact scenario right there not create the clawback, or what was it? The
recapture.
Yeah. Does that not trigger that?
Well, if he's selling it below his cost, then he might not be. I mean, he's selling it down to his depreciated value possibly, so that he's not really creating recapture possibly, because he's selling it, if he takes $1 million deduction, he's got 7 million into it. He takes $1 million deduction, that takes his cost basis down to 6 million, and he's selling it for 6 million, or he's selling it for below his cost, but he's selling it at his basis. So he's not going to have, in that simple example, taxable income from the sale.
His investors also, they get dollar for dollar tax credits. He takes a paper loss early, a paper loss, mind you, because remember, he's now just selling it while it looks like it's $1 million loss. It's offsetting his gains elsewhere. And as you just said, it may not be a real loss, it's just a paper loss. Um, Rents are weak and the sale looks like a loss, but the fees are where he makes his profit. His tax credits have a huge value, and the depreciation, which we're talking about today, is accelerated, is an additional benefit. The building doesn't have to make money, the structure does.
You guys agree with that, or is ChatGPT flawed?
Well, certainly that is a scenario of how people can use uh, cost segregation in structured transactions. Um, and frankly, I think in a lot of real estate development deals where the investors are coming in, they can get a deduction up to the amount of sometimes even slightly more than if there's debt involved than the amount of their investment is. So they're putting 100,000, 200,000 down. They could get a year one deduction because of the leverage of greater than the amount of their investment. And that's just how some of these deals were structured.
So, what does the IRS look for in a properly conducted study, and how do you ensure compliance? Because a lot of people are like, "Oh, this is great. I'll just take the deduction. I'll just accelerate it." Talk to me about the rule book that that you
I,
mentioned earlier.
I'm going to answer the first part of that question, then I'm going to let Sumit kind of go into some of the details. But the first and foremost, a report, like was an actual study done? And I think that there are people out there, whether they're tax preparers or the like, that just kind of give it the eyeball and like, well, I've seen other cost seg studies done, and I kind of know what the percentages were, and they just do that, and that's not acceptable under the eyes of the IRS. That will get kicked out every time, 100 out of 100. Um, but if you have a study that's properly done, then your chance of success move up to closer to 100 out of 100. I'll let Sumit kind of get into the layers of what do you want to make sure are included in there.
Just
Yeah, sure.
before, in reporting that, is that a line item that says that literally like 400B that says you're taking that accelerated deduction and you're putting it in that slot?
So if it's in a new acquisition on the first tax return for that acquisition, it's just showing up as depreciation. It's not called out separately. If it's a catch-up scenario, I've owned the property for 7 years. I never did a cost seg on it. I'm doing the cost seg today. I'm going to do the catch-up depreciation deduction. That catch-up depreciation deduction is known as a 481A deduction. That is separately reported. It's called out in the change of accounting method, which is a separate form that goes with the tax return. So you are actually referencing the assets that were identified under the cost seg study. You're referencing the original depreciation and the catch-up depreciation and the difference. That difference is the additional line item. So yeah, it is much it is called out, and it's much more obvious when you do it subsequently. Doesn't mean it's more risky. It's just more
Exactly.
visible.
All right, sorry, Sue.
Yeah.
Keep interrupting.
No, absolutely. I think that's a good segue, Roberto, because I would premise this: cost segregation doesn't raise or lower your risk of audit. We talked about how the tax law has been in existence for many years. It's been litigated. So just because these studies are taxpayer beneficial, I don't want your audience to kind of misconstrue that, I'm doing something that benefits me. Does that look bad in the eyes of the IRS? No, not at all, not necessarily, no. Appropriately classifying assets into their most appropriate classification, whether they be tax advantageous or not, is doing the right thing, by the way. And so what does the IRS look for if, God forbid, an audit is, the study is scrutinized? I think the reporting is absolutely key. the level and the quality of the reporting, what kind of modeling, what kind of cost assumptions were used to build that model. Even, in some cases, they look at the practitioner who's doing the work. So within the cost segregation industry, we do have an organization called the American Society of Cost Segregation Professionals. This is an organization that certifies individuals that do work like this. I am a certified individual, for example. They maintain a certain minimum quality of standards as to how these reports should be prepared. So that's one thing to kind of look for as well. Who's the professional, who is the practitioner doing the work? And then additionally, there's certain cost resources, cost manuals that are prescribed. I mentioned the Audit Techniques Guide that gives guidance as to what things should and should not qualify as personal property. These are all the things that go into a quality report. And then, was a site inspection occurred? Did an engineer even see these assets with their own eyes? These are just some of the factors that are considered and lead to a quality result and a quality report.
For example, so give me an example, because I'm imagining, and give me an outrageous one. I mean, I get it when I buy a house and maybe the contents of the house, but a lot of people, that's kind of ordinary. What if I buy a hotel? What if I buy storage units, which was one of your case studies? I mean, it's hard for me to imagine what I could separate out, because the storage units are a cinder block building, and the units are empty. So
Yeah.
where's the
No,
opportunity?
it's a really good question, and it goes back to the very first statement that we said. This is something that applies pretty ubiquitously to all real estate. Any investor that's buying or building property should at least be thinking cost segregation, having that discussion with their tax professional, because to your point, John, it applies. There are certain property types that can lead more benefit than others. We've talked a lot of examples of single family homes, residential rental. They're towards the high end. They can lead, as we said, maybe 20 to 30% of the basis on average can be reclassified. Hotels is another good example at the high end of that range, because there's a lot of infrastructure inside that building. Think of all the flooring, think of all the bedrooms. There's often built-ins, in the lobby. There's a lot of decorative finishes. A casino, for example, there's a lot of electrical, plumbing infrastructure for the equipment. Towards the lower end, I agree with you, John, like maybe a warehouse. Those are more simple structures, but, 4 walls, a roof, concrete floor, there's not a lot going on inside. However, a lot of these warehouses have significant site infrastructure, very large paved driveways, parking areas, truck landing pads, ponds for
I think I
stormwater.
found the example. I put in 100 Main Street and I put in hotel, and I changed it to hotel, and my savings didn't get any better. Still $250,000. But I put in car wash. If I buy a car wash for 1.4 million, are you kidding me? I could save 1.4 million up front? How does that
Well,
work?
you found a unique one. So car washes and gas stations fall into a unique section of the code that allows for essentially almost the entire basis value of the property, structural value as well, to be written off. Those are unique property types: car washes and gas stations.
So our listeners ought to go out there and find themselves some car washes.
But
The car
to
wash business has definitely been thriving since bonus depreciation was brought back to 100%.
but what back when that was written, what was the thought process or the philosophy for the carve out of that type of business to be, to have that advantage? Like, who's sitting there saying, well, these, and this is the reason why, and
Yeah, it's not that it was that type of business that was carved out. It's really what components of the building or the property can be used as a building. If you think about a car wash, it really isn't so much of a building as it is a structure that cars drive through that's steel, and it's generally not contained as a building.
Yeah.
And four walls and a roof with a floor and a door. And so that's why in the example of a warehouse where it is four walls, a roof, and a door, there's not a lot going on inside. It's just a bunch of empty space. Um, but when you think about like how about some of these facilities that are being built for all the computer equipment, the data centers, their special raised flooring with cooling units and all this stuff that it's four walls and a roof, but it's got a lot of stuff going on in it.
I put in
So,
casino and I got $750,000. I guess there's a lot of stuff going on in the casino.
So your listeners need to go out and buy casinos as well. Car
that's right.
washes and casinos.
A
Still someone
Valvoline.
sitting in that room, they're saying, I think we should depreciate the water on that car wash.
And without turning this into sort of a political podcast, Roberto, I mean, the oil and gas lobby is strong, so there are specific carve outs. It's rare; these aren't often asset types that we deal with, but there are specific. We mentioned car washes, gas stations, specific depreciation tax rules for property on Native American Indian reservations, specific carve outs for farm property. So there are special rules in some of these unique areas, but generally speaking, most real estate falls into a traditional realm. Many of the benefits, but yeah, those are just a few areas. If you have clients that kind of deal in those areas.
Is this tax planning for, I guess, for retirement? Let's say, I've put a bunch of my assets in trust for my kids, and they include real estate. This is a way to take money out of the real estate where, I'm just leaving it in the trust for my kids. I'm not intending to sell it. So I'm okay accelerating some of the depreciation on this. Is that another example that we're starting to see as the baby boomers age and they're starting to think about tax structures and
I
trust?
I want to talk about a trust structure because this is pretty slick. So you have somebody that owns an operating business and they're going to put some of that operating business into a trust. And provided that they are not the trustee for that trust, they've got a corporate trustee. That trust is receiving income from that operating business. Let's say it's a partnership or an S corp, and they're getting a flow through of income on a K1. Let's say it's $100,000 a year for the benefit of their kids going into that trust. And maybe they don't want to give that cash to their kids. They for estate planning purposes, they put the investment or a portion of their stock into that trust, and they want to continue to take the cash flow that comes from the business into that trust and reinvest it. Well, if they reinvest it in real estate, first of all, the income coming from that activity, the operating business, once it comes into the trust, it's a passive income. If they go out and they take that $100,000 that they got in cash flow and they buy a property with that 100,000, let's say they buy a $400,000 rental property, they're going to get a $100,000 passive deduction if they do a cost seg study on that, and they just wiped out their income, that $100,000 of income that they got from the operating entity in that trust. So it's really slick if you're trying to look for, hey, most of the time people that have passive losses from real estate activities where they're not a real estate professional, their problem is, well, I don't have enough passive income. You just came up with an example where you actually can generate passive income and do estate planning at the same time and create some really slick ways to invest in real estate.
So what I hear you saying is I bought the car wash for $1.4 million and I put it into the trust and it kicks off 100 grand every year. I'm not going to pay tax on that 100 grand, and I'm putting it into another piece of property. I'm not paying tax
It,
on it
yeah,
in the
if
trust and it's considered passive income.
so let's say that you take the 1.4 million, right, on the car wash year one against your income. Okay, then you put the car wash into the trust, and the car wash is kicking off, 100,000 or 200,000 of profit a year, whatever that number is. Then the trust with the car wash income goes out and buys rental real estate and uses the depreciation deductions to offset the car wash income. And every year they could just go out and buy another piece of real estate and wipe out that income, and you're creating a perpetual real estate investment machine that's tax efficient, very tax efficient.
Wow. That was
If I can
great.
add, if I can add another scenario in this topic of estate planning, John, I think it's a really good question. I really like it. What we often get called is, say, a parent has deceased, some benefactor has inherited a property at a stepped up value, and then we get a call, well, I just inherited a property, almost like an act as if they've acquired the property. So it's an obvious opportunity to apply a cost segregation. Specifically when a benefactor inherits a property at a stepped up value, there are some limitations on bonus depreciation, to be clear, but still a unique opportunity to apply a cost segregation, identify accelerated depreciation, get some tax benefits for that benefactor. But what often gets missed, we see, is applying the cost segregation for that deceased individual, because they still need to file a return for a portion of the year that they were still around. And so, there's an opportunity to not only apply the cost seg for the stepped up fair market value for the benefactor, but also apply the cost segregation on the final return for the deceased individual. And that gets missed, especially if there's taxable income and an opportunity to reduce that, because otherwise those would be lost forever if you didn't apply it on that final return.
Wow.
Wow.
Like I said, over my head.
Well, I always like to remind people that to get their CPA involved in the discussion, about what you're doing with your investments. When you're investing in real estate, when you're investing in your business, you always want to make sure and just have that upfront discussion. What are we doing? And how can I do this in a way that's tax efficient? Can I get deductions? Where can I get those deductions? And we came up with some pretty slick examples of how to do that. And I know, John, we had talked about the short-term rentals, which is another very popular loophole these days. Lots of people have properties that they bought, maybe in a beach community or a mountain community that there's an opportunity to rent that out. And it's typically not rented out for months at a time. It's somebody who just wants to Airbnb it. I want to VRBO it. I'm going to rent it for a week. If someone is doing that, that is an active activity if they can demonstrate that they are materially participating. And all that means is you spend 100 hours a year. And there's a couple of other nuanced rules, and I won't get into that nuance, but this is why you want to talk to your CPA about it. But if you have income from that property, you can actually generate a loss from a cost segregation study and then offset that loss against your regular W-2 income or your active ordinary income, even if you're not a real estate professional.
I was given the example earlier, Roberto. I said, so Roberto and I, Roberto sold some fabulous townhouses in New York, big, beautiful townhouses. And I was surprised to hear that the owner put it out there available to rent. And I thought, oh, this is a smart tax strategy. He didn't buy it with the intention of running it as a business, but if he rents it out just a little bit, he's going to call this. And so I think that's the example you're starting to use. You're saying that as long as even though his intent was to use the townhouse, if he rents it out just a little bit, what happens?
Well, I'd be careful using the word intent, because if the IRS is looking at it and says, well, your intent is to use it,
Mm-hmm.
then your intent is not to have it as a short-term rental. And so we want to make sure if it's a rental, regular rental, like I could rent it out to somebody for a year, if I've got other rental income that I can offset, right? That's one way, and I could get a massive deduction against other rental activities, which could involve, income from gains from rental activities. But if it's a short-term rental, then I have to rent it as a short-term rental. I shouldn't be using it. There's very clear rules around that, and that's why again we want to get our CPAs involved. We want to talk to our CPAs about what is our plan before we do it, right? The reason why we put our on our site the ability to calculate or estimate, what the benefits might be is so that people before they do something, they can look at what it would mean and then have that conversation with their tax preparer, their tax attorney, their CPA, and say, if I did this, is that going to work? Here's
Well,
what
let's
my
say I'm
plan
not
is.
using it, but I really did buy this to park, as an investment and to park some
Sure.
money in a safe asset for a
Yep.
period of
Done all
time.
the
I
time.
intend to use it and move to New York at some point in the future. So now
Yeah.
I'm advertising it to
Yep.
rent, but it's a $30 million townhouse and the rent is quite substantial. So I don't rent it all that often, right? It's a losing business. I'm not using it.
Right. That
It's
is
a
done.
losing business.
That is done all the time.
Okay.
And just what is it? Uh, does it qualify as a short term or does it qualify as a passive activity? Is the only determining factor as to how you report it and how much of that loss you could use. And a lot of people that have the means to invest in a $30 million townhouse to park the money, they've got plenty of active income and they've got plenty of passive income. And so they might be able to say, yeah, if I get a $7 million tax deduction, I can use that all up in the first year. I'm gonna do that.
Excellent.
How would the IRS define John's term of renting it a little bit? How do you define
Well,
that, John?
Well, let's pull up the example. 1541 Ocean Boulevard. I asked for an address before the show. This is a property in Newport Beach. I looked it up, and it's got a $4.2 million value on Redfin, and I see it's advertised here for $400 to $3,000 nightly rate. Talk to me about this case study.
yeah, so these types of properties are oftentimes rented out, anywhere from 100 to 250 days a year, just depending on the seasonality of the location. Some places can be, a much longer time, but if you're renting it out that much and it's 7-day rentals, that is actually considered an active trade or business. And if you generate a loss because of the depreciation from that active trade or business, then you're actually able to offset that loss against your other ordinary income.
So the answer, Roberto's very specific question, what's a little bit? Well, you've advertised this. It's available 52 weeks out of the year. It's not your fault that it only rents out 4 weeks during high season during the year. It's still a losing business, right?
Yeah.
Yes, provided that you can demonstrate that you are materially participating. That's the 100 hours rule that I gave.
Mm-hmm.
And that you're not using it more than 14 days or 10% of the total rental time. So like I said, there's some special rules around this short-term rental rule, but this is a strategy that is being used widely uh, because lots of investors have these types of properties that are working for them. And if you got somebody that has a lot of wealthy people, they own properties in Jackson Hole, Wyoming. They own properties in, South Beach. They own properties out in Cape Cod or the Hamptons or wherever. And they're oftentimes a way for them to invest and park their money. But, they might go visit it for a week at a time, and that's okay. as long as if they're renting it out, they can actually qualify as a short-term rental.
What's the takeaway? Meaning, both one, if I'm sitting here and I'm listening to this, am I qualified? How do I know that cost segregation is for me? And where is this going? As you mentioned, with the big, beautiful bill, we've now got bonus depreciation. It's made this a very hot topic. Is this also something that could go away in the next few years or change in the next few years?
So the first thing is, do I have taxable income? If I don't have taxable income, there's no need to think about this. So that's question one. Question two, am I investing in real estate or do I want to invest in real estate? The answer to that is yes. Then, okay, now I need to look at, is cost segregation going to benefit me? I have taxable income and I'm investing or planning to invest in real estate. Now the question is, if I generated a loss from that real estate, can I offset taxable income that I have? Do I have the kind of taxable income that I can offset? Or can I structure my activity to provide deductions and losses against the income that I have? And that's what we kind of talked about, whether it's through a trust, whether it's through a short-term rental activity, whether I can qualify. If I invest in real estate a lot and I meet the 750 hours rule as a real estate professional, and I spend more than 50% of my time in real estate, then I can take losses against any activity. It doesn't, I can have $1 million of dividend income and interest income, and I can create losses from my real estate activity and offset that completely.
Okay, so if I make an income and I like real estate, then I like investing in real estate, then I qualify.
Well, then you need to be looking at whether or not it benefits you. Because again, if you're a passive taxpayer, it could benefit you or it may not benefit you. There's a threshold we need to cross there. And if you say, well, I want to structure it in a way where I can benefit from it, then that's the conversation you have with your tax preparer, your CPA, your tax attorney to say, okay, based on my circumstances, how do I make sure I'm benefiting from doing cost segregation on this property?
Okay, and so my last question was, what's the outlook on this? I think that when I've talked to my CPA about some of the laws and how they're changing and how the government is thinking about taxing capital gains, will that go up, and tax rates? What's the feeling in your industry among you experts on potential changes to these laws going forward?
Well, I wouldn't expect any immediate changes. The legislation that passed less than a year ago was a big deal. Getting that done won't be, changing that won't be easy to do in the near term. And bonus depreciation has been around for a long time. I don't see that completely going away. It was tapering off before they brought it to 100%. Cost segregation has been around for a long time. I don't see that completely going away. I think the real estate lobby is very strong. Real estate is a huge depository of wealth in this country, in the world. And so I think for any policy that they can create to incentivize people to invest long term, I think is a good one. And so they're going to continue to create favorable policies for real estate investors and real estate holders.
Well, this
If
is
anything,
great.
John, the legislation that continues to come out continues to identify new opportunities for different real estate owners. One of the things that we didn't talk about, but it was part of the one big beautiful bill, was for build in America again, manufacturers, to increase production in America. There's actually new legislation to incentivize those types of taxpayers to build their factories here in the U.S. So there are new laws that continue to incentivize even further deductions, further benefits. So, to Jason's point there, I really do think the real estate lobby is very strong. It has a power in Washington. I think Washington realizes that. And so I think there's new and creative ways to generate even further offsets, to layer on top of cost segregation.
Well, the takeaway I got was that on a $1.4 million purchase of real estate, I might, using a cost segregation study, be able to save $250,000 to $500,000 on typical residential real estate, but that can be as high as 1.4 million if it's a car wash, and nearly that if it's a casino. I don't have any casinos I could buy around here for $1.4 million, but I'll be looking. This has been a great show, Roberto, right? Not a whole lot of math. It's fun.
What is up with you with the math? I was a economics major.
I know, but you don't like to do podcasts on math. No. I get it. This has been Boroughs and Burbs. You'll find us at boroughsandburbs.com. This is last week's episode 221 up there. You'll see this week's episode 222 on probably within a half hour at boroughsandburbs.com. And there will be links to both the audio and probably to the video, although you'll find that on YouTube. I'm John Engel, and you'll find me at johnengel.com or theengelteam.com. Roberto Cabrera, is that the latest newsletter?
Nope.
Okay.
I mean, it's the last. It's the last one, but there's a new one coming out on Tuesday. Okay.
RobertoCabrera.com. Look for it. I want to thank our guests, Jason Melillo of KBKG and Sumit Sharma of KBKG. This has been great, but you're going to find their website at costsegregation.com. That's what it looks like. And be sure to check out the calculator lower down on the home page. And with that,
guys, this was really good.
This was really good. This exceeded expectations, right, Roberto?
100%.
Yeah.
100%.
We kept you awake the whole time talking about taxes. So
that was intriguing.
This is good stuff.
Yeah.
I want to go buy a car
Thank you,
wash.
John. Thank you, Roberto. This is actually my first podcast ever.
Oh my God, you were amazing.
So I'm breaking history with you. So thank you.
Podcast today, Tonight Show.
He's going to have his own podcast next
week. Thank you, guys. And I may be calling you on my next piece of real estate. See if it's eligible for a cost segregation study.
Absolutely.
I hope it's a car wash.
Me too. Me too. Bye-bye.
All right. Take care, guys.